Hello, everybody. Welcome to another Fit Talks. What a special Fit Talks this is going to be. We get a chance to spend some time with Howard Sharfman, who's the CEO of FinFit Life, and is actually one of the very influential, important people in the financial services industry. One of the best, and works with several businesses, high net worth people, and has been known to build businesses and work with entrepreneurs to help them grow their business and maximize family wealth and their own personal wealth. Well, so welcome, Howard. How are you?
I am wonderful. So excited to be here. And Bill, good to see you.
Good to see you. And it's I wish we could spend more time together, but I'm always happy when we get the chance to spend some time together. I'm really looking forward to this conversation. Today, we're going to talk about several subjects, but this subject today, we're going to talk about business insurance. And as you know, small businesses, most of them think that they are going to have this economic event and that's going to be their retirement, but many of them don't know how to properly plan for their business, to protect it, and more importantly, provide for them in the future, other than just chasing the goal of the business to make more business. And you've worked with business owners for several years. I'd like to first start off with one, if a person owns a business, what are some of the things that they should be thinking about for their longevity of their business or protection of their business?
Sure. Well, let's start with, I'm not sure what you just said was 100% accurate, in which most small businesses never have an economic event. Most small businesses never have an exit. If there's an exit, most small businesses will transfer from one family member to another. Now, none of that is bad. People enjoy being entrepreneurs. I was an entrepreneurial studies major in college. I enjoy being an entrepreneur. And people tell me they enjoy being entrepreneurs because they like the freedom in the fact that they could work when they want and not work when they want, which means they're going to work all the time as an entrepreneur and as a small business owner. But most of them have a very hard job. And they have a very hard job with the hardest boss ever. And that boss might be themselves, it might be a spouse, but what really is their checkbook. And they know exactly how well they're doing based on the economics of their business. And there's no hiding from that, like some people hide in corporate America. So, but we can't assume that there's not going to be an equity event. We can't assume there's not going to be a liquidity event, and we have to plan for it. And a lot of times there's not a liquidity event because we didn't plan, because there are two partners and one of them passes away without a plan in place, because there's a key employee that's not insured and something happens to that person either through disability or death, and there's a significant diminution of value. And a lot of times people just don't prepare. So let's start with that, which is, what do you do to prepare? Does that make sense?
Absolutely. And you mentioned a few things there. If we could maybe start with one, when you hear this often with a business owner that especially has a partner, you need to have a buy-sell agreement in there. What is it and why is it important? And then what should people do about it?
Sure. So a buy-sell agreement is exactly what it sounds like. It's an agreement that two or more partners have on what will happen if one passes away or maybe becomes disabled or upon retirement. You see, the best time to negotiate something is when everyone's happy, when everyone's getting along, when the decision makers are in the room together, and you could have a respectful, positive conversation. So if Bill and I are partners in a business, I want to negotiate the exit when we're starting the business. I want to negotiate the exit when we're running the business. I don't want to have to negotiate the exit when Bill's not here, or Bill's disabled, or Bill's dead. And I'm telling the story, so I killed Bill off instead of myself. But so a buy-sell agreement is that path. Because what do we really want? If Bill and I are partners and heaven forbid something happens to Bill, one, there's a diminution of value. Bill is a key person in our business, and we're going to get to key person coverage. But now my business is not as valuable. And now Bill's estate's business is not as valuable. So that's a bad time to negotiate something. Also, Bill's trustee or executor of his estate now has to negotiate about a business with someone who is overpowering in the negotiation. And I don't mean that because it would be me instead of someone else, but it's someone who's in the business and understands the business. It's not a fair fight to someone who is not in the business and doesn't understand the value of the business. So a buy-sell agreement says, if heaven forbid something happens to one of us, here's the roadmap. Here's the rule of the road. And what that means is if Bill's estate then has shares of this company. Well, I don't want Bill's estate to have shares of the company. I want to have those shares of the company, or I want the company to have those shares, or I want other ones of our partners to have those shares, because I need them to entice the next person to come and run the company, to promote the next person to that role. And what Bill would want is liquidity in just cash for his family to invest and to live on if something happened to him. So the best time to negotiate that's upfront, and we could do that in two different ways. One is called a cross-purchase agreement. And a cross-purchase agreement means that I buy Bill's shares, and Bill would buy my shares if something happened to me. Now, those are both that's a good start, because that's a document that says we are going to value the company based on the following metrics. We could put in its book value. We could put in its X times the profit. We could put in, we're going to have the company valued by 3 appraisal firms and average them. And however we want to do that, it's fine. But it's an arm's length transaction, and we're going to agree on how a business is valued. And then we have to agree how it's going to be paid. Because are we going to pay it up all up front? Are we going to pay it over time? Is there interest on that debt? Is that debt in the first position in the company, or is it behind other debt or other equity or other obligations? So the buy-sell agreement says, heaven forbid something happens to Bill, that then I am obligated to buy the shares of the company for a predetermined formula or price, and that will be paid out either in lump sum or installments. Now that's a good start, but that's not it. Because let's say the business is struggling. And let's say, not of course our business, but someone else's business.
Right.
And let's say that business is struggling and they don't have the liquidity to buy out the other partner. Well, that document is worth exactly as much as the paper it's written on. There's no way that could happen. So we have an amazing product that solves that. If I own an insurance policy on Bill's life, and Bill passes away, and I get $20 million, and then I buy the shares from Bill's estate for $20 million, then we both have what we want. 1, I have the shares, and 2, Bill's estate and his family has the money. So that's the perfect solution, as long as that's the right formula that we use. Mm-hmm. So 1, we review these documents. We make sure the formulas are still in line with market multiples. We update insurance. And maybe the document would say, we're going to use a formula, and that formula is 10 times earnings, and on the average of the last 2 years of earnings. And the payment will be the amount of insurance that we have in place on Bill's life will be paid out immediately to the extent of the value. But if the value is more than that, we're going to pay the additional amount over a 10-year period of time at a 5% interest rate. And everyone agrees on that when everyone's getting along and everyone's healthy, and it works. And if heaven forbid something happens to me, Bill receives a insurance payment, and now Bill is bound, and my estate is bound to sell, and Bill's bound to buy for that price based on we will pay the amount of insurance we have out up until the value. If the value is more than that, we'll then pay it over a 10-year period of time at an interest rate. Well, that seems to make things work. So there's one more special thing that happens with a cross-purchase buy-sell agreement that is different than an entity purchase buy-sell agreement. Well, going back to killing off Bill, and so Bill's gone, and I receive a life insurance payment for $20 million. Life insurance, as we all know, comes in income tax free. So now I have $20 million of after-tax payment in cash in my account. I then write a check to Bill's family. That's an additional investment in the business. So I have the original investment we put in, but I just put in 20 million more. Why is that important? Because when the business is sold, my basis was whatever the original number was, plus $20 million. So I pay less tax when we eventually sell the business. Bill, on the other hand, his basis is stepped up because on death, if you own an asset, the basis is stepped up on death to the fair market value, and that fair market value is determined by our contract. So let's say it's $20 million. Bill's estate receives $20 million tax-free because the estate had a basis of $20 million because there was a stepped-up basis, and they received $20 million, so there's no gain. So I get a stepped-up basis because, or additional basis because I paid for it. Bill's estate would receive no income tax on that because the estate had a stepped-up basis. So that's really important in a good quality of a cross-purchase agreement. The other type of agreement is an entity purchase agreement. Now, an entity purchase agreement means the company owns an insurance policy on Bill's life. And upon Bill's passing, the company receives the benefit. Now, the company has the money, and the company buys the shares from the estate, and the company is bound in the exact same way that I was bound. So the company will buy the shares up to $20 million up front, and if the valuation formula says more, we'll pay out over time. But for discussion purposes, we'll say it's $20 million. And the company receives $20 million income tax-free because one of the great qualities of life insurance, again, is benefits come on tax-free. And then the company pays Bill. So Bill is in the Bill's estate, and Bill's estate is in the exact same position because his shares were stepped up at death, and now they have cash, so there's no income tax. But what we miss is having the stepped up basis at the company level because it's an entity purchase agreement. So, which is fine. It typically isn't done when there's two shareholders because it's quite simple to have a cross-purchase agreement with two shareholders or three shareholders or four shareholders. But if you have 400 shareholders, that means I need to own 399 insurance policies on my other 399 partners. Well, it's just not possible. So in that case, we would use an entity purchase agreement. Well, if it's a smaller business with a small number of owners, then we use a cross-purchase agreement. But the important takeaways here are: one, do the planning when everyone's getting along and everyone's healthy. Two, create a formula that creates the value. Three, do this in conjunction with your trusted attorney and other advisors. And four, the single most important thing in all of this is make sure you have life insurance to fund that agreement, because without that, what you're expecting to happen probably won't happen. And the reason is because that business build shares might be worth $20 million, but might not be free cash flow to do that. Because we're using that cash flow to expand, and we're using that cash flow to invest. And if we took it away and gave it to Bill's family, then the business wouldn't grow as quickly as possible. Bill wouldn't have wanted that, and clearly the survivors wouldn't want that. So make sure there's life insurance. Make sure that life insurance is reviewed on an annually or biannual basis. And when you do this for your clients, you have reasons to talk to them. You have reasons to update things. There's future sales. And you're really helping people in a way that others don't.
Well, you covered a lot of ground there.
I did. Sorry.
It's good, but there's a couple things that I think if you would help clarify. What is there a number where cross purchase it does get too much? Is it 5 people? Is it 4? Is it 10? Or is there a defined number, or is it just kind of go by feel?
I would say it goes by feel, but anytime there's more than 5, it becomes a little burdensome. So we use typically an entity purchase agreement instead of a cross purchase agreement. And by the way, there can be a combination of it in which many companies start with a cross purchase agreement, then the company grows, but we could keep some of those shares personal, or some of the policies personally, and then some of the policies as a entity purchase agreement. It's a little more complicated, but at the end of the day, what we want in a perfect world is we want the shares being in the hands of the survivors, and we want the liquidity being in the hands of the estate of the deceased.
Mm-hmm. One last question about this to end. I'll call this buy-sell segment. You mentioned reviewing like every 6 months or so. How often does a buy-sell agreement really change? Is it when there's a change of ownership, or there's a change of investment types that are into the business? If you could kind of walk through that.
Sure. So there's many triggers. One, it should just be reviewed every year, every 2 years. Because without that, as the financial advisor, as the financial security professional who's worked with the company to place the insurance, without reviewing that, I don't know what it's worth, which means I might not have enough insurance, because a lot could happen within a year, a lot could happen within 2 years. Mm-hmm. So one trigger is we just talk to people to talk about values. Second trigger would be a new partner could come in. It could be an institutional partner. It could be a corporate. It could be an individual that we promoted to partner, let's say, or someone that bought into the business, or a merger or an acquisition. So there's by having these discussions with your clients, you have a reason to call them back, to understand what's going on in their lives. You'll find out that kids get married. You'll find out that they may have estate tax issues. You'll find out they may have referrals for you. You'll find out lots of things about them, and you'll be there in a way that you would want to be there for them, and they would want you to be there for you.
Makes sense.
They would want you to be there for them.
Yeah, makes sense. And then that always lends itself into the next biggest question is, you have an organization where you have, I'll call it a person who's leading that business, a CEO that is very valuable, or you have a kind of a rainmaker salesperson that is driving 80% of your revenue. You would look at a key person insurance. When is that really applicable, and how do people best use that concept to protect their business and maybe even provide future growth in their business?
Yeah. So in any business, if you look at a business on an objective way, and you say if something happened to one of our shareholders, if something happened to one of our day-to-day executives, would there be a diminution of value in the business? Would the value of the business go down? If the answer is yes, should we insure that person for life insurance as a key person or for disability insurance as a key person?
And Howard, it was an obvious one that was like with Starbucks. They brought in a new CEO. The value of the company went up tremendously. It was very obvious that his value to the company is significant.
Absolutely. And there's so many people in technology companies. Think of Elon Musk's value to all of the companies that he has. There would be a significant diminution of value if he passed away. Probably not enough insurance in the world to cover that, but with most of our clients, there is.
Yeah.
So it could be as simple as someone has the relationships, as you said. They have the relationships, they're in charge of sales. They might be the key engineer in a business, they're in charge of ideas. They might be the face of the business and in a marketing way, and there would be diminution of value if they've passed. So the key there is, how do you quantify that? It's very difficult. And there's limitations on how much insurance one could purchase on a key person. I think a good rule of thumb is we can insure people for up to 10 times their income for a key person. So if someone's making $1 million a year, we could insure them for $10 million. If someone's making $100,000 a year, the insurance company will not believe that they're worth $10 million to that company. Mm-hmm. Because you would pay them more or her more if they were. So the insurance companies, 10 times is a good rule of thumb. In special situations, we might be able to convince an underwriter to insure someone for more. And a lot of times when we're doing this, there's a key person structure and there's a buy-sell agreement structure, because a lot of times these people are owners of the company. Mm-hmm. But the key is, one, there's the company has liquidity to go for a search and look for the next person. The company has liquidity to go through the valleys of maybe losing a few clients who are only there because that key person is in charge. What was there in the relationship, and without that, all the competitors come a-calling. And money doesn't solve all problems, but it helps. Mm-hmm. And I don't know any company that wouldn't be better off by having that insurance policy in force on one of their key people. So the issue there is, technically, the insurance policy is owned by the company. The beneficiary of the policy is the company. The proceeds come in income tax free, but the premiums are not tax deductible. And this is the only time I'll tell you that it's good that the premiums aren't tax deductible, because if the premiums were tax deductible, then the benefit would be taxable. Mm-hmm. That's kind of the rule of taxation. So since you don't deduct the premium, you don't have to pay tax on the benefit. And I'd rather not pay tax on the big number, the benefit, than deduct the little number, the premiums. The other thing is that what type of insurance is all of this? Yeah. We didn't, in our last segment about buy-sell agreements, we didn't touch upon that in key person. So buy-sell agreements, it's very important to match the asset with the liability. So if this is a family business, and maybe it's a buy-sell agreement between family members, and they're not going to transition the business until death. We see that often. Well, that needs to be a permanent insurance policy, because you have permanent liability, you need a permanent asset. Makes a lot of sense. I started my career as a banker, and we like matching assets and liabilities, and when banks match their assets and liabilities, they don't go broke. So the same thing with life insurance. We match the asset and the liability. Buy-sell agreement forever? Well, that's permanent. However, let's say there's a private equity driven company and 80% of it is owned by an institutional buyer, 20% of it's owned by my family. The buy-sell agreement might only be one way. I would want that private equity business company to own an insurance policy on my life so they could buy out my shares, so my family gets cash and they get the liquidity to pay for that. Mm-hmm. Because I wouldn't want my family to be partners with them without me.
Right.
And that makes sense. But if that private equity fund has a short-term view on things, and let's say the structure of the fund that owns 80% of the company has a 7-year life. So the fund has a 7-year life. Maybe it has an extension of 2 years, maybe even two 2-year extensions. So the most it's going to have is 11 years. Mm-hmm. Then they're going to be out. Someone else is going to be in. I'll probably be out, not in this business, but in another fictitious business we're talking about. In that case, a term insurance product is completely appropriate for 10 years because our liability is 10 years. We need an asset that's 10 years. If we're insuring a 35-year-old as a key person in a business that we plan to own for a long time, we probably need a key person life insurance policy. But if we're insuring a 65-year-old who already told us they want to retire at 70, one, as a business, we have to manage that to replace that key person before they're gone. And two, we would need a term insurance policy. It's a short-term solution. Match the asset with the liability. Mm-hmm. In a key person policy, the asset's the person, the liability is how long they're going to be a key person. And what I tell parents who own businesses when they're in business with their children, you're a key person today, but one of your jobs is to make sure you're not a key person in the future. And I would tell that to all of our directors at FinFit Life. You're a key person in your business today, but it's your job to mentor all of your other directors to become the key person so you're no longer the key person. And that might take 5 years, 10 years, 20 years, whatever it takes. But it's just how you run strong businesses.
So Howard, about the key man insurance, walk us through how can that potentially, because it's technically an asset of the company, how does it work in succession planning, and how might it work maybe even in a potential executive bonus for somebody that's leaving or something like that? How do somebody think through that?
Sure, and I'll tell a story of what I did this morning. Literally this morning, I spoke to a CEO of a company. We'll call him Andrew because his name is Andrew. And Andrew is a key person for this company. He is also a 20% owner of this company. And he's the driver, and the company is doing great. So the board of directors said, boy, we need key person insurance on Andrew. I said, great, no problem. The company also said, it's a family office that owns this company, besides Andrew and a few other people, but the family office is in charge. And the family office says, if something happens to him, not only do we have diminution of value of the business, and we need that key person insurance, but we also we're contractually obligated to buy his shares. And we don't want to allocate more money to this business. We've allocated a lot to it. So we have a buy-sell agreement, kind of a one-way buy-sell agreement, because it's Andrew would sell, and the family office would buy, or the entity would buy, either way. And that benefits everyone. But the key person doesn't benefit everyone. It only benefits the surviving shareholders. So Andrew said to the board, I am all in favor of you insuring my life. But here's what I want from it. I would like to have a $5 million life insurance policy paid as an executive benefit. And immediately they said, yes, no problem. So our part of that transaction is that we sold one insurance policy as a key person life insurance policy owned by the company with the beneficiary of the company. The company pays the premium. It's a non-deductible asset, and the death benefit would come in tax-free. The second part is a buy-sell agreement between, and we didn't do it with the company, we did it with the family office. The family office pays for the premium. They own the policy. They're the beneficiary of the policy. The non-deductible expense for them. If Andrew dies, they get the money and they buy out his shares. And then for going along with this, and part of his executive compensation package, they're going to put together a $5 million executive benefit program for him, and that's a permanent insurance policy. There's probably a 10-year run in this business for the family office. We wanted to give ourselves some wiggle room, and Andrew's pretty young, so we wrote 20-year term insurance on the buy-sell agreement and the key person. We did a permanent policy for the executive benefit, as described before.
Got it. Wow, that's a very unique situation, but it's probably not uncommon because many businesses are like it. Huh.
It's not that uncommon. Think of all of the private equity funds that have a key person, a CEO, a president, a chief sales officer, a key person in this company that also owns the company, part of it, that this solves the problem for. It ties the executive to the company, and they're tied anyways. They have a significant amount of equity, but still, I had a client tell me more is more the other day. I didn't think I would quote him, but I just did. Right. And so this was an enhancement to their executive benefit program. It was protecting the company and protecting his family. What a win-win for everyone. And we just really helped this company. And by the way, this is the second time I've talked to the company. The first time we put in a small insurance policy. This time we expanded it all. And I'm sure it's not the last one. And one of the last things that Andrew said on the call today with me was, okay, when do we review this? They said, well, tell me your growth rate and, tell me when you think. So I said, why don't we, we'll talk a year from now and see where the values are and see if this insurance is still appropriate. Wouldn't it be nice to have a whole book of business where you're going back to talk to the client and they probably have additional need?
Yeah. Wonderful.
That's what job security is.
Right. That's right. And now speaking about executive benefits, that's another very big topic with people that are wanting to keep the right people in the business, doing the right things and focused for their long-term growth, but also meet the needs of those key associates or key executives. Walk us through kind of that process.
Sure. Most of the great investors would say, we invest in jockeys, not horses. People, in the excellence of people, will create value in businesses. Ideas create value, but execution is what perfects that value. And if I had to choose between a great idea and a pretty good idea with great execution, I would take the execution every day. Okay? So knowing that there is such an asset out there in employees, showing that the world's changing. I read an article the other day. We know that athletes and entertainers have business managers and agents, right? That's not foreign to anyone. But do you know who else is starting to have people negotiate their contracts with them? Hedge fund managers. There's an ex-hedge fund manager that started a agency to represent the best and brightest of portfolio managers or PMs in their negotiations with big hedge funds. And if you Google this or look at what some of the deals that companies like Citadel or Millennium Capital or other great hedge funds are paying their portfolio managers, they're more than athletes and entertainers. And they have people negotiating for them. Why? Lots of reasons. One, they want to be a portfolio manager. They don't want to negotiate with their boss. And unless they've signed their life away in past contracts, and in most states that's not even legal, that they can move from one firm to another. And if I have a hedge fund, I want the greatest and best portfolio managers. I'm willing to pay for them. And so if that's the case, we have to help clients design executive benefit packages that reward and retain. Sometimes they're called golden handcuffs. And it's a combination of everything. The combination is cash compensation, short-term incentives, and long-term incentives and benefits. Okay? So many of those involve insurance solutions. They're more sophisticated insurance solutions, but they're still insurance solutions. So some of them you might hear is deferred compensation. So in a deferred compensation program, an executive could defer part of their compensation. That money is always vested to them. But if the company is going to match that benefit, that might vest over time. So the word golden handcuffs come in because it becomes gold in the long run. But the person and the company are tied together. So if that's the case, it's a win-win for everyone. If someone says you could put up to $100,000 into this deferred compensation plan and we will match it 1-for-1 or 2-for-1 or 50 cents on the dollar. And if you stay 5 years, so every 5 years, it will vest. That's a win-win for everyone. You do this for the employees that you want. Now, and the person, he or she, gets value out of that. So the economics of that are really interesting. So the economics and the tax economics of it. In deferred compensation, the executive gets to defer their compensation. So instead of making $1 million a year, they put in $100,000, and their W-2 compensation is only $100,000 less, or $900,000. The company is only able to deduct $100,000. I'm sorry, is only able to deduct $900,000. They're not able to deduct that last 100. So if they're profitable, they would pay tax on that extra 100. But a lot of times these are done by high growth companies that are using all of their money and have depreciation because of CapEx. They might not be real profitable. So at that point, they're not giving up anything in the deferral. They also, in the match, they're not deducting that until it's paid. So if I put in $100,000, the company puts in $100,000, the company's not deducting $200,000, but that money is going to grow, and when it is provided, when it's vested, it becomes taxable. So at that point, we get a deduction. So you might have been in a situation where the company wasn't profitable, you didn't take a deduction, and when it becomes profitable, you get to take a deduction. So that's very positive. And most importantly, that person stays with the firm. So there's many ways to do this. There's many arrows in our quiver. One is a deferred compensation program. The other is a 162 or executive bonus program that can either be restricted or not restricted. Some of them have restriction covenants, some not, but a 162 bonus program is a way that under IRS section 162, a company could deduct reasonable compensation that's paid to an employee. So if I paid an employee in cash, they have the money in cash. But I could, under 162 bonus, I could pay them in the premium of a life insurance policy. And just like if the company gives you cash, or the company gives you a car, or a company gives you anything of value, that should be compensation to the employee and deductible to the company. So in a 162 bonus program that doesn't have a restriction, the company gets to deduct the premium. The employee picks up that premium in income and has to pay tax on it. So a lot of times these are called double bonus programs or triple bonus programs in which, let's say it's $100,000. They put it in a 162 bonus program. They buy a high cash value life insurance policy with it. The executive picks up $100,000 in income, and now they owe $40,000 in tax. A double bonus program would say that the company also pays them a $40,000 bonus to pay that tax. A triple bonus program would say they pay them $40,000 to pay that tax, and they pay him another $16,000 to pay the tax on the tax. Now, you could take this to the nth degree, but singular double bonus is pretty much where it is. Once again, helps to be a golden handcuff, benefits, and part of a whole package. And packages, as I said, they include cash comps, long-term comp, and benefits. So, and then the third type of program is a split dollar life insurance program. A split dollar life insurance program says an insurance company, the company purchases a life insurance policy on the individual. Since I'm telling the story, the company buys an insurance policy on me. The insurance policy has high cash value, but death benefit also. And thus, if I pass away, my family gets the benefits of the life insurance policy. If I live till retirement, I get the cash value less whatever the company paid at an interest rate. Okay, on a loan split dollar program. There's also another way to do it, but just for simplicity purpose today, we'll talk about the program as a loan. So the company gives me a loan, essentially, to buy this life insurance policy. They have vested interest in equal to the amount of the loan and interest on that at what's called an AFR interest rate, or 77, the governmental rate that is used. And so if they put in $300,000 of premiums over the years, and there's a $2 million death benefit, and I get hit by a truck, the company gets their $300,000 back plus interest, and my family gets the rest. They get the money back tax-free. I get the money back tax-free. I paid, every year, I paid for the economic benefit of that policy. And that's a governmental table or an insurance company table that's provided that has some benefits, basically the term insurance value that's included in my pay. So in that case, in a split dollar policy, the company could provide a benefit. The company could have an asset on their books, and the accounting for that is they move money from cash to pay an insurance premium on my life. So they have a receivable, because remember there's a loan, so there's a receivable. So it moves from cash to accounts receivable. That accounts receivable earns interest. And then I've signed not only a split dollar agreement that says my heirs will pay this back, and typically it will come directly from the insurance company, but we will assign part of the policy to the company so they make sure they get the money back. Mm-hmm. And that's a split dollar program. So with these type of executive benefits, you have deferred compensation, you have 162 bonus programs, you have split dollar insurance, and we could have a deep dive into this on each of these and the ownerships and the documents needed. But what I would say is, for your first transaction like this, talk to someone who's an expert and partner with them. Make sure that there's a qualified attorney that's opining on it and writing the documents. Make sure the accountant understands the accounting entries here. And you will have a client who has a better business because their key people are locked in. You will have key people that are happy because they have this benefit that they didn't have before, and they know you helped them provide it. The last thing in all of this, and I'll go back to my client Andrew that I spoke to today, in talking about his buy-sell agreement and key person and executive benefit, I said, Andrew, as long as I have you examined and I have offers on the table, let's talk about your estate planning and any additional personal planning you need to do. And I am sure, and we haven't had the conversation because we haven't underwritten them yet, but once I do, I believe it's more likely than not that we'll do personal planning too for the executive. So I'll have not only the executive as a client, but also the company as a client. And I'll have a way to go back and continue to talk to them about their increase in value.
Wow. It's the great part about this is there's businesses all over the place. So there's a very large marketplace. And if somebody wants to get knowledgeable about this, there's plenty of information. One, you as a resource, this podcast as a resource. But there's certainly people that would want to help, that are qualified to help, that they could split business with. Just refer an expert in and go practice.
We have so many people within our FinFit Life ecosystem that could help with this. And it's a great business. It is a more advanced business than doing individual planning. However, it's another arrow in our quiver of how we could help people. And let me just add one more thing. If we're doing this with the John Hancock Vitality product, it's a wellness program. And we help people live a longer, healthier, and better life. So isn't that something a board of directors or your partners want, is for your executive to live a longer, healthier, and better life? And that is embedded in this program.
Yeah.
And that's pretty exciting.
Yeah, it's fantastic.